Okay, hello. So this is our class to replace the missing class that we're going to have on Tuesday. And the class on Tuesday, or for our Tuesday class, we're just going to recap the perpetual method and then look at the periodic method. Um, and we'll kind of see what that looks like and compare and contrast the two. And then following your viewing of the video, you will have an assignment that is going to be time sensitive, that you will have to complete by before our next class, which is Thursday. And so it's going to be surrounding the journal entries, because one of the things you do need to understand is how to prepare journal entries under both methods. There are times when they test both methods. So you need to understand if they say it's a perpetual method, which we should know means that we're continuously updating inventory, versus periodic, where we're going to see that it's not updated every time. It's just updated at the end of a particular period of time. And so we're going to see what that looks like. But first, we're going to just do a brief recap of the perpetual method. Going back to the textbook and the notes given and the stuff that we talked about in class, this is your reminder that underneath the perpetual method, the main difference is that between perpetual and periodic, every time we sell something, we also have to account for the movement in inventory. So if I sold an item in inventory, that means my inventory, the amount of inventory I have on hand should have decreased. In accounting, the same thing happens in our books. The inventory account that we have should also decrease based on the cost of the inventory. Same thing with when we purchase inventory. If I purchase inventory and I bring it into my business, inventory increases. And so the inventory general ledger account should also do the same thing. That's the main difference between periodic and perpetual. We're making sure we're accounting for when inventory is going up and down. Okay. And so that therefore means that if I go to a sale, so a sale on credit, if I sold goods, what happens is I have two entries. One where I'm recording the sales, the revenue, which is normally a credit. And if I receive cash, it would be debited cash, or because this is on credit, it's accounts receivable. This we are already familiar with. We just have to remember it and continue to get used to journal entries. So we would do this for a sale, but underneath the perpetual method for accounting for companies that have inventory, they also need to reduce their inventory balance, which we should know that inventory, which is an asset, is reduced by a credit. And so we'd have to credit the merchandise inventory account for the value of the inventory that was sold. The debit would be cost of goods sold, which we said is an expense account where we put the value of the inventory that we have sold. And so we expense merchandise just like we expense supplies. When we use the supplies, we would put supplies expense. It's the same concept with inventory. When we sell it, however, we expense it through this account called cost of goods sold. A reminder that when we look at a question underneath inventory type transactions, especially for the perpetual method, you'll see that they tell you two numbers. One, they tell you the amount that you sold it for. So this is the portion that's related to sales and accounts receivable or cash. And then they tell you the cost, which is the amount that's related to inventory and cost of goods sold. Again, the difference between the two is a profit. If I buy something for $10, I'm not going to sell it to my customer for $10. I would not make any money. It doesn't make sense. I shouldn't be in business because I clearly don't understand how to run a business. And so the lower amount is always going to be the amount that we put to inventory and cost of goods sold. Debit, cost of goods sold, credit, merchandise inventory. This amount here is always going to be the amount that we credit to revenue or sales, and we debit to either cash if we received cash for that sale, or we debit it to accounts receivable if we have not received the cash. And so they said it's on credit, so we should know that that's our tell that says that this amount is not, we haven't received any cash for it, therefore it should go to accounts receivable, which is why they selected the accounts receivable account. Okay, that's just your basic sale. We have instances where there are returns. When returns happen, that means most times the inventory is brought back and put back in inventory to be sold later. When a sale happens, they usually, or a sales return, sorry, they're going to tell you how much is the cost of merchandise inventory and how much is the sales. Again, the larger number is how much I sold it for. The smaller number is usually how much the cost is. And they tell us the cost because we need to reverse the cost of goods sold. So take it back off of our books with a credit. And we need to put the merchandise inventory back in the books with a debit. At the same time, if somebody returned $300 worth of stuff, what's going to happen is they don't have to pay me that $300. So what I had in my books, likely as an accounts receivable of $300, is no longer receivable. And so therefore, we have to remove it from accounts receivable with a credit. And we would debit what we call the sales returns and allowances account, because we don't just debit sales. And so as a reminder that those are the two accounts that we use definitely with along with the sale price when there is a return. And then we also want to debit merchandise inventory, putting that $180 inventory back in this inventory system. And crediting cost of goods sold, which is an expense. When we credit an expense, we're decreasing it. So this 180, when we sold it, went to cost of goods sold. And when we return it, we take it back out of cost of goods sold. That's what's happening there. So those are the two entries that are involved with returns. When we have receipts, it's similar to what we already know. Somebody came and paid on account. So cash is received, account receivable goes down. That we're familiar with already. I'm gonna go back. I think I might have missed one. Just want to confirm. Oh, that's a sale of merchandise. Now, on the other hand, when we have the purchase, well, before I move on, the cost of goods sold amount, we would know underneath the perpetual system. We don't have to calculate anything. So that income statement is pretty straightforward. When we talk about purchases, which is the other side, if I purchase inventory, what we're paying attention to is how much we purchase the inventory for and the terms, so that when we go and make the payment, we determine whether or not we can take a discount or not. So they purchase inventory for $4,890. There's only one entry for the purchases side. The two entries parts happen with sales for the perpetual system. With this purchase of inventory, I have to increase my inventory with a debit for the value or the amount that I purchased the inventory for. And they said on credit, so that's accounts payable. On the other hand, if it was they paid cash, then we would have simply credited the cash account. Purchases, returns, just how sales could be returned, purchases can also be returned. And so that means the inventory that I had on my books, I'm now giving it back to my vendor. Therefore, I don't need to pay the vendor for the value of that inventory because I no longer have it. And I no longer have it. Therefore, I need to take it out of my inventory account. So that's why they are crediting an accounts payable to subtract from accounts payable, because that amount is not due anymore. If I give you back something that I paid for, I don't have to, that I bought on credit, that means I don't have to pay for that anymore. If I don't have to pay for it, it's not considered accounts payable. We have to reverse it out. Same thing with merchandise inventory. Merchandise inventory is returned. Therefore, I need to take it out of my inventory balance because it's not there. I don't have it anymore. Payment on account is the same concept. We make it a payment on accounts payable. We record a reduction of accounts payable. We record the receipt of cash. Always be mindful that when you have returns, again, if I bought something for $1,000 and I returned $300 worth of stuff, I'm not expected to pay back. And in my accounts payable, once I did my entries correct, $1,000 isn't there anymore because I would have reversed out 300, leaving 700. So a lot of times it's up to you to notice what the actual accounts payable is supposed to be. And of course, it's going to be things purchased minus anything returned is what's left in accounts payable to be paid. All right. Also pay attention to discounts. When we have discounts, discounts need to be recorded as well. And we should see an example of an entry like that. Let me go back and see if it is here. I don't recall. I don't recall where they show me the actual entry. I'm just gonna check. So it's not there. So we haven't come across it yet. But just know that if there are discounts, then we record that a specific way as well. All right. And so that's just a recap of the perpetual method, again, where we're accounting and making sure we adjust inventory every time. The next method we look at is going to be the periodic method. And with the periodic method, like it says, the cost for, in terms of the income statement, a major feature of the income statement is a computation of cost of goods sold. The cost of goods sold must be computed on the income statement because it is not updated every time we have a purchase and a sale and other transactions as with the perpetual system. So this is going to be something that you're normally tested on. This is something to remember. In order to figure out cost of goods sold, you have to know certain things. And so this is definitely what we will go over in our Thursday class. But just take a look at it. It's a formula that we'll discuss. And with using a periodic income statement, they do not just give you the cost of goods sold. You normally have to calculate it. And it's calculated by taking beginning merchandise inventory plus purchases, less purchases return, plus freight in. It gives me net cost of purchases minus all of that other stuff, and minus ending gives you cost of goods sold. Again, don't worry about it today. We'll go over this next class, but you have to be prepared to complete something like this because they do like to test on this. Okay. And so let's go back now, or let's go and look at the entry side of things when it comes to this periodic method, and let's identify the differences. So with the differences, like it says, in the perpetual system, the merchandise inventory account is adjusted each time there's a purchase, a sale, or another transaction occurs. In the periodic system, the merchandise inventory account stays as its beginning balance until physical inventory is recorded at the end of the month, at the end of the period, usually a month or a year. The periodic system uses a purchases account to accumulate purchases and a purchases return and allowance account to accumulate returns and allowances. So these are the only two types of transactions that happens with purchases of merchandise, just like with perpetual. I buy inventory, I return inventory, I pay off inventory. Those are your three things that are happening. And so let's see how it differs from the perpetual. So in the same question here, it says in this case, we purchased merchandise on credit for $4,890. Underneath the perpetual method, we would have debited merchandise inventory and credited accounts payable. Underneath the periodic method, we don't call the account merchandise inventory, we call it purchases. That's the only difference. I'm not using a merchandise inventory account, I'm using a purchases account underneath the periodic method. Why is this important to know, or why is it done that way? Because you need the different totals in order to calculate your cost of goods sold. So there is a purchases account. There is a purchases returns and allowance account. There is a freight in account. Everything else is calculated except for merchandise inventory. Okay, so like it said, the merchandise inventory in this case last year was $211,200. That account will stay the same until they do an inventory count and until they reconcile and figure out what cost of goods sold is. At the end of the period, once they know what cost of goods sold is, they're going to take it away from and post it to, its relevant account at the end of the period. So we don't use cost of goods sold until the end for periodic inventory method. Okay, so purchases is used instead of merchandise inventory, and then we have accounts payable. Now, if on August 6th, we return a part of the merchandise received for credit for 480, yes, we take out accounts payable 480, but we do not credit merchandise inventory. We credit purchases, returns, and allowances. So again, nothing touches merchandise inventory account underneath the periodic method. The same 480 is reduced. When we have freight that happens, when we receive a bill for freight and we have to pay this particular bill, we would debit the freight in account. That is an inventory account, but we call it freight in. Be reminded that freight in is any cost that I needed to pay to get the inventory to come to my business. Freight out is any cost I have to pay to get the inventory to go to the customer. So freight in is what will be debited. Accounts payable would be credited in this case because they said they received an invoice. It didn't say they make a payment. All right. And like it said here, freight in is used on the income statement to net purchases to arrive at the net cost of purchases under the periodic method. When payment happens on account, it's the same concept. We still only make payments to accounts payable, so that does not change. So as it relates to the periodic method and purchases, the only thing that changes underneath perpetual, we would have debited merchandise inventory when we purchase inventory. Underneath the periodic, we're not debiting that account, we're debiting the purchases account. And then when I'm doing a return, I'm going to credit merchandise inventory. However, periodic says we don't touch that merchandise inventory account. We actually credit purchases, returns, and allowances. So that's the purchasing side. The sales side of it, sales on credit, it says on August 7th, Kawa sold merchandise on credit. The FOB destination, $1,200. The cost of merchandise was $720. Well, in this case, because it's the periodic method, I am not doing anything with the cost of merchandise. That's $720. I don't touch it because again, I'm not updating inventory every time. I wait until later. And so I'm only concerned with the larger number, which is the 1,200. And it's the same as what we did with the 1,200 underneath the perpetual method. I would have debited accounts receivable for 1,200 because it's on credit, and I would credit sales for the $1,200. No second entry is required at all for this periodic method. Then we'll see with the same example of the return of merchandise. Again, I'm not concerned about the cost. That doesn't matter underneath the periodic method, so I ignore it. But the larger number, the 300, I cannot ignore. And so when I come down to it, sales returns and allowances is debited for 300. Accounts receivable is credited for 300. As you can see here, compared to the perpetual method, that has not changed either. Nothing has changed with the entry itself other than I'm not putting that inventory back into merchandise inventory account. Receipt on account is the same concept. Again, cash, accounts receivable, nothing has changed compared to the perpetual method. Okay. And so, like I said, I mean, there are small differences between the two. It has to do with periodic method does not take into account the movement in merchandise inventory. The perpetual method does, and then periodic method has different account names. Okay, you should be familiar with both of them. What I'm going to do is I'm just going to show, let me see, I want to show an example. I think we looked at this example in class. This one here. So this is an example, and I think there's only one page. No, it's 2 pages. Okay, so this is an example, a side-by-side of different entries underneath both methods. And so this is a sale of merchandise on account to Eric Ortega. When we look at the perpetual method, we have 2 entries. Okay, sorry. This one here, accounts receivable 210, sales 210, and cost of goods sold 1260, merchandise inventory 1260. The periodic method only has the first entry, the exact same entry, accounts receivable and sales. The names of the account don't change there. It's just that we don't need to do this particular part. When we purchase merchandise on account, underneath the perpetual method, I'm adjusting merchandise inventory and accounts payable. Underneath the periodic method, I don't call the account merchandise inventory, I call it purchases. And so purchases is debited, accounts payable is credited for the value never changed. When I paid freight in cash, that does not change either. We use the freight in account in both instances. Again, I purchase merchandise on account, terms N30, FOB shipping point, meaning that the person that we bought the goods from sent it to the shipping point. It's up for us. It says it's paid by the freight paid by the supplier. The supplier included freight costs in the amount that, we have to pay back to them. They paid freight costs. So a part of that 3,600 we have to pay back to the supplier includes $200 in freight. So whenever we see freight paid by the supplier, we have to make sure that we don't put that entire amount to the merchandise or the purchases account because, for proper keeping track of things, that freight is freight and we have to put it in a freight account. So therefore, this is a three-way entry. If you can look at it, 3,400 plus 200 is 3,600. My debits and my credits are equal. The accounts payable amount was 3,600. And that accounts payable amount can be split into the 200 paid in freight by the supplier plus a 3,400 in merchandise inventory. So always remember to split the freight. It remains the same on the other side, except that we call the account purchases and we don't debit the merchandise inventory account. With sales returns and allowances, we accepted a return of $300. Nothing has changed with this first entry. We take it out of accounts receivable. We add it to the sales return and allowances account. But however, underneath the perpetual system, they have an extra entry for that return to adjust merchandise inventory and cost of goods sold. The periodic system, we never touch merchandise inventory. We never touch cost of goods sold. We just wait. When we return a portion of our inventory that we purchased, that means that we don't owe that amount anymore. So we reduce our accounts payable and we reduce our merchandise inventory underneath the perpetual system. Underneath the periodic system, again, we're not using merchandise inventory. Yes, we reduce accounts payable, but we reduce our purchases, return, and allowance account. When we sell merchandise for cash, again, the first entry for any type of sale remains the same, whether it's cash or accounts receivable. Sales credited, cash debited, in this case for the amount that we sold the inventory for. And then the cost of the inventory underneath the perpetual method, it says that we have to record cost of goods sold as an expense and reduce merchandise inventory for what we sold. Underneath the perpetual method, they have no reason to record that entry because they don't care at that time. They care about it later. And so therefore, that's why there's no entry there. We made a payment on account for that accounts payable. And they're just pointing out the fact that initially we bought $3,800 worth. There's $600 worth that was returned. Therefore, 3,200 is the amount that we have to pay back. And so that's the amount that they pay in accounts payable, and that's the amount of cash that they have to spend to make that payment. The same thing happens on the periodic side. Nothing changes. Accounts payable decreases, cash decreases. On the same point, when we have now a sale where there's a return, we have cash that will be debited for cash received. Accounts receivable is received, so we can take it off with a credit as well. Initially, we sold $2,100 worth of goods. They returned 300, so it's really only 1,800 that we have to collect and that we will collect on. Okay, and so whether it's periodic or perpetual, that does remain the same. All right, and so that's just pretty much what we cover for the majority of this chapter, especially for today's session. I'll also point out something, and it's in the appendix of this chapter. What you're gonna find is that there are different journals that are used for different companies. We have sometimes journals that are called sales journals, purchases journals, cash receipts journals, cash payment journals. And so back in the real world, not the real world, but back in the day, when they had paper journals, they would have these different paper journals. But computerized systems also still have these journals in set up a certain way. So you have your general journal, which we should know our general journal includes everything, all the debits and credits, no matter the type of transaction, everything goes in the general journal. But these special purpose journals, what they actually do is they hold things, specific transactions. So every sale goes into the sales journal, but it won't go in the purchases journal. The purchases journal only holds purchases. And so here's an example, scrolling down, of what a sales journal may look like. These are just all of the debits and credits that relate to sales. And so normally for custom companies that are, recording sales, they record sales on a daily basis. There's normally a customer account that is associated with a sale. Invoice numbers are prepared, and there are certain terms and certain amounts. And so the sales journal, as well as all these other journals and ledgers, they are just keeping track of specific types of transactions. And so this sales journal is keeping track of specific types of sales so that at the end of the month, at the end of July, they can see what the total sales are. Okay. We could also see that in our sales ledger, but our sales ledger doesn't give us this level of detail. It'll pretty much just give us, our date, the reference, and then it's going to give us the debit and the credit amounts, but we wouldn't know who those sales are for and invoice numbers and the terms given. And so therefore the sales journal gives you more specific information about sales. At the end of the month, usually what happens is this total from the sales journal goes directly into the sales ledger and the accounts receivable ledger. And so that's what they're showing here. So sometimes you're going to find that some in real world accounting, you're going to find that there are some accounts that are fully detailed, and then there are some accounts that just bring everything in summary. And that's what this is showing. So the sales journal shows everything in detail, but in accounts receivable and in sales, the debit and credits are happening, but they happen as a total and not as the individual sales. And sometimes it just makes it easier to trace and understand and see the data that we want to see. What I want to say is that they call these accounts control accounts. And so these are an account in the general ledger that maintains the total of balances. And then we have a sub-ledger, which is separate and usually has a list. So this would be considered a sub-ledger, and this would be considered a control account. It carries information in summary versus a subsidiary, not subsidiary, not subsidiary. Oh, yes, a subsidiary account carries the detailed data. You don't need to know much about this, but just, understand how it works. Just checking everything out here. Yeah, and so what happens as well, it's important to know, accounts receivable would include because if we look at it, I guess, all of the sales are for different customers. Maybe only one person bought twice, Peter Clark. And so this account won't be able to outright tell me everything that happens with Peter, but Peter's account is an accounts receivable account. And so there's a general accounts receivable account, a control accounts receivable account, and then there's usually a sub-ledger accounts receivable account that further breaks down accounts receivable. Yes, the total accounts receivable is 4,950, but there are going to be one, two, three, four, five different accounts that come back to that 4,950 if we wanted to figure out how much does Peter Clark owe or how much does Georgetta Jones owe. And so this is an example where they're showing you here that as a part of the sub-ledger for accounts receivable, and accounts payable does the same thing, there's one for each customer that allows you to see all of the transactions for that particular customer. So even though we recorded multiple transactions for different customers, different sales, different receipts, and it all said accounts receivable, in computerized systems, there's a sub-ledger that's keeping track of everything for each individual customer. And so whenever Peter Clark gets an invoice, that's going to be debited to his accounts receivable sub-ledger because it's acts just like accounts receivable account. And then whenever he makes a payment, it's going to be credited to that same account so that we could figure out what the individual balance of Peter Clark actually is. All right. So that's going to be important to know. And like it shows here, usually there's a schedule of accounts receivable or what we call an accounts receivable listing. Like I said, accounts receivable total is 4,950, but that's made up of 5 different customers. This should always come back to what's in your actual accounts receivable account. And so that's usually considered to be reconciling the account or balancing the account. Your subledger totals should always come back to your control amount as well too. I'll also say in journals as well, when there's taxes involved, sometimes they have different accounts. The ledger or the journal may be expanded a little bit more to keep track of sales taxes. Because normally if my sale is $200 and I'm charging, let's say, a VAT tax on it, that sales amount plus the tax is what is considered to be the amount receivable. I cannot put how much ever my tax or my VAT is into the sales account. I have to separate them. And so sometimes the journal can be expanded to look like that. All of these are still sales journals. Here we have an example of the purchases journal, which is the same concept. We're keeping track of the purchases from the various vendors and the terms and the invoices and the amounts in total in my and in detail in my purchases journal subsidiary account. And then the total amount goes to my general ledger for accounts payable and the purchases account. Okay. Because again, this is purchase account that tells me that we're using the periodic method. And again, there's an accounts receivable or accounts payable subledger that keeps track of the individual items for each vendor as well. So we have dealer sales, Jones Chevrolet. Jones Chevrolet has 1. Dealer sales has 2. So a $700 and a $3,200. Those 2 amounts go to the dealer sales account. But at the end, all of my accounts payable subledgers should come back to what's sitting in accounts payable as my balance, 9,200. And I'm sure they're going to show that as well. Hopefully they do. Okay, they didn't, but just know that that happens. And then this is just an expanded version of that as well too. Cash receipts journal, just as we think it is, cash receipts or cash received from accounts receivable customers are kept track of separately as well. This allows companies to have different reports. These reports give, more detailed information. But that's what that account is for. It keeps track of all of the cash that is received from the different customers. Okay. And then there's a cash payment journal, which does the same thing, keeps track of all the payments made to vendors. And so these are just basic things to have an idea of, but nothing to worry yourself about too much. It's just important to know that for companies, there are general journals, then there are control accounts, and there are subsidiary accounts that give more detail than the general journal will. Again, I can't go to the general journal and see who I made a payment to because all of my payments being made go to accounts payable. But in the control account and in the subsidiary, well, in the subsidiary account, I can see that, okay, I made a payment to GV Power. I made a payment to BTC. I made a payment to insurance management, those type of things. Okay. So it's supplementary, but it's important to just understand the concept because sometimes they do like to test it in the multiple choice. So, pay attention to these special purpose journals. They serve a purpose that's greater than the regular journals that we've seen. They give more detail and they allow us to see specifically who's doing what. Who are we making payments to? Who are we selling to? Who are we buying from? And who are we receiving payments from? Okay. And so once you're done watching this video, you can continue on to the next step, which is an assignment on the journal entries surrounding the periodic method and the perpetual method.